Advanced taxation. So we were doing the ATX June 21 exam. So let's resume it. We ended up yesterday on at question number 1, right? So let's continue today from question number 2. Let's try to complete this paper today. And in the meanwhile, if any one of you want to ask anything relating to ATX from any topic, from any point which you guys want to understand, please do let me know. I would be happy to answer. So I'm going to start the question. You should assume that today's date is 1st June 21. Your manager has had a meeting with Fiona, a potential new client of your firm. Extract from the memorandum prepared by your manager following the meeting and from an email which details the work you are required to do are included in the exhibits. The following exhibits are available on the left-hand side of the screen, provide information relevant to the question. Memorandum extract from your manager dated 1st June 21 and email extract from your manager dated 1st June 21. This information should be used to answer requirements within your chosen response options. Fiona. Fiona is 74 years old and is in poor health. She has lived in the country of Parila since 1990. She has a son, Hugo, and a daughter, Elena, both of whom lived in the UK. Live in the UK, not lived, live in the UK. Fiona will move to the UK on 1st August 21 and acquire a home there. Fiona domicile and residence status. I have already established that as a result of moving to the UK, Fiona will become UK resident on 1st August 21 under the split year basis. Fiona will also be UK resident in the tax year 22-23. So for part of the year, the first line entails, for part of the year, she will be UK resident. And for whole of the tax year 22-23, she will be UK resident. Fiona is domiciled in Parila. However, once she becomes UK resident, Fiona will be deemed domiciled in the UK for the purpose of income tax and capital gains tax because she was born in the UK with a domicile of origin, with a UK domicile of origin. Fine. Gifts made by Fiona. On 1st May 2020, Fiona gave Elena for 30,000 in cash. The money was transferred from one of Fiona's bank account. Just to highlight, such things are of great importance over here. 1st May 20, so she's transferring it on 1st May 20. 1st May 20 means she was not in the UK that time and she will be returning to UK on 1st August 21. Fiona previous gifts are set out below. These are all gifts of assets located in UK. Such that they are subject to UK IST despite Fiona being domiciled in Parila. Whether this statement is given or not, so it's the gentleness of the examiner that he mentioned this point specifically. Otherwise, if he not mentioned this point specifically, this is a by default assumption, as in UK assets are always subject to UK IST, right? The amounts shown are after the deduction of any available annual exemptions. 1st August 12, a PET of 94,000. 1st July 15, a chargeable lifetime transfer of 74,000. 1st September 19, a potentially exempt transfer of 204,000. When Fiona's husband died in 2012, the whole of his nil rate band was used when calculating the IHT liability in respect of his estate. This statement means none of the NRB spouse NRB is unused, i.e. all of the NRB of a spouse has been used. Gifts to be made to Hugo. Fiona owns a number of houses which she rent out to long-term residential tenants. These houses are located in either Parila or the UK. Fiona intends to give one of these houses, either Aber House or Belb House, to Hugo within the next 3 months. So today is 1st June 21, from 3 months from now. July, August, September, within 3 months. Both of the houses were acquired in May 2016. So both of these houses were acquired when she was not in UK. CGT gift relief will not be available in respect of gift of either property. So yes, this understanding, we have the same understanding, since if the houses are let out to long-term tenants, i.e. not under the FHL, there will be no gift relief kind of a stuff would be available. The expected gain loss on disposal of each of the two houses is set out below. Aber House, which is located in Parila, loss on disposal of 50,000. Belb House, which is located in UK, there will be a capital gain on disposal of 85,000. Property and interest income. Fiona anticipated income for the tax year 22-23. The year after she moved to the UK is set out below. Property income, property situated in UK, property situated in Parila. Interest income, UK bank interest, Parilian bank interest. The income arising in Parila is a stated gross of Parilian tax. Fiona will remit all of the rental income in respect of properties situated in Parila to the UK. The interest arising on the Parilian bank account will be retained in Parila. Okay, so rental income will be remitted to the UK, whereas other than rental income will be left, like the bank interest income will be retained in Parila. Tax system in Parila. The rate of income tax is 18%. There is no IHT or CGT. There is no double tax treaty between the UK and Parila. Fine. What the manager wants me to do in respect of this? Please carry out the following work. Becoming Fiona tax advisor. Explain the actions which we should carry out before we became Fiona tax advisor. I have already obtained her address and her proof of identity. It is basically the discussion which we were having yesterday in relation to the ethics related stuff, where we had a discussion on becoming tax advisor. So this is a commonly examined feature as part of the ethics. So be watchful of that. Gifts to Elena and Hugo. You should first assume that Fiona's death will occur on 30th April 2023. So we should assume for this part of the question that Fiona will die on 30th April 23. IHT payable in respect of Fiona gift on 1st May 20. Calculate the IHT payable as a result of Fiona death in respect of the gift made by Fiona to Elena on 1st May 2020. So I am only supposed to calculate the IHT in respect of the gift made on 1st May 2020. Then proposed gift to Hugo. In respect of Fiona proposed gift to Hugo, for each of the two houses, whether or not a chargeable gain or allowable capital loss will arise in the UK, whether or not gift will be within the charge to UK IHT. So 2 points. On the basis of your explanation, advise Fiona which of the two houses she should give to Hugo and whether the gift should be made before or after Fiona has moved to the UK. You should not prepare any calculations for this part of the question. So no calculations are required for this part of the question. Explain why the remittance basis will be available to Fiona in the tax year 22-23 and whether or not she will be subject to remittance basis charge. So the verb over here is explain. So I'm supposed to explain all that, not calculate all that. I'm supposed to explain all that. Calculate Fiona income tax liability for the tax year 22-23 based on her anticipated income figure. So you are supposed to calculate Fiona income tax liability based on her anticipated income tax figures. So this part looks pretty much straightforward of the question. For this part, whether or not chargeable gain allowable capital loss arise in the UK. So there will be one explanation relating to capital gains under both the houses. And there will be one IHT discussion for both the houses. And so there will be like 4 headings for this part of the question. One Aber house IHT, one Aber house CGT, one Bleb house IHT, one Bleb house CGT. And based on your explanations, advise Fiona which of the two houses should be given to Hugo and whether the gift should be made before or after. So fine. So carry out the work, how the marks are allocated, becoming Fiona tax advisor, 5 marks. Gifts to Elena and Hugo, IHT payable in respect of Fiona gift, 3 marks. Proposed gift to Hugo, 7 marks. And the taxation of overseas income, where the first part belongs to the taxation of overseas income, availability of remittance basis, and second belongs to the income tax liability for the tax year 22-23, right? Hmm. So I'm closing this out. My own personal sense. we should keep our calculations on Word and put the reference of the workings wherever we deemed necessary towards the spreadsheet. Okay. Like I very categorically discussed yesterday, be careful about the formatting. So I understand there is no professional marks over here, but it will give overall a good or bad impression over the examiner, like whether the candidate is a professional or not. So that's why we should be careful on this piece. Explain the actions which we should carry out before becoming tax advisor. So I'm going to address the actions we should carry out before we become tax advisor to Fiona. Anything which you guys want to table on this piece, please. Anything which you guys want to table in this piece relating to the ethics. Any point which any one of you want to table. Contact the previous tax advisor. Fine. That's great, Moses. Good to hear this, because especially your second point is very much relevant, considering the fact she is a very wealthy individual and she just like moved back to the UK. So yes, I strongly agree with you. We should be very vouchful on these aspects, on these points, which the second point which you have just mentioned. So let me start tabling this. Generally, one of the common comment in this situation is we need to ensure there was one thing specifically mentioned. I have already obtained her address and proof of identity. So one important aspect always is the address and her proof of identity. But since that piece is already captured, so I'm not going to address this point over here. Okay, so let me start writing to this answer based on the feedback provided uh, by Moses. First is we should obtain permission from Fiona to contact her existing tax advisor in order to ensure that there is nothing in the past which would prohibit us from accepting the appointment as tax advisor on ethical grounds. Keep remember 5 marks for this. We should ensure ourselves that Fiona is not involved in any form of money laundering, we must consider the fundamental principles of professional ethics like integrity and due care. We should ensure that whether becoming the tax advisor to Fiona would create any threat to comply with these principles. If any such threat is identified, we should not accept the appointment unless the threat can be reduced to an acceptable level. Via the implementation of safeguards. One more point, which Moses just referred over here. Fiona moved to the UK. It will significantly affect her tax affairs, and we must be sure that we are able to deal with the technical aspects of these matters. Um, Anything which is not clear? B1, IHT payable in respect of gift. Mm, let's put it bold only. I need to revisit this point. Uh, I have really established, okay, on 1st May 2020, Fiona gave for 30,000 in cash. The money was transferred from one of Fiona bank account. Fiona previous gifts are set out below. These were all gifts located in the UK, such that they were subject to UK IHT despite Fiona being domiciled in Parila. The amounts are shown after deduction of any available annual exemption. So this is like after deducting the annual exemption, right? Now, working one. In respect of Fiona gift on gift to Elena on 1st May 2021.
Recording in progress.
Which is by the amount for 30,000 less annual exemption of fiscal year 2021. Annual exemption of 1920. Already used in PET of for September 19. Net PET value amounts for 27,000. Then nil rate band by the amount 325,000. CLT within last 7 years, the CLT is by the amount 74,000. This is the CLT which is like made on 1st July 2015. Less PET. As a result, NRB available for PET of 1st May 2020. $380,000. Would we get any type of taper relief over here? So for this part of the question, 30th April 23. So there will be no taper relief. Why there will be no taper relief? It is 30th April 23, right? Now looking for your comments. To Moses, it is basically on account of the 7-year accumulation principle. So in case you are clear with the 7-year accumulation principle, it will not be an issue for you. But in case if you are not clear with the concept of 7-year accumulation principle, this will bug you then. So yes, we are considering the taper relief. We are considering the taper relief at time of death. So since Fiona is expired as per the assumption in April 2023, that's why we are considering the taper relief over here. So that's why we are considering the first IHT and then IHT. We are considering the taper relief over here. Is this thing clear? I was thinking that this working is based on PET gifted in 2020. So what are we supposed to calculate? We are basically supposed to calculate the IHT implications of PET first made in 2020. So it was exempt at the time of transfer, but since it is assumed that the Fiona will expire on 30th April 2023. So all of these workings are prepared on 30th April 2023. So if you look into the heading, so this is based on the assumption which is mentioned in the question that she will expire on 30th April 2023. And since this gift is on 1st May 20, so 1st May 20, 1st May 20, 1st May 21, 1st May 22, 1st May 23. So it's like one day before she's expiring, 2-3 years for taper relief to be available. What of if two calculations were done at the time of gift and at the time of death? So what if two calculations was done at the time of gift and the time of death? So you can, so by default, yes, it is the case. It is the case. Like first we have to consider the 7 year, the at the time of transfer calculation, then we have to prepare the death time calculation. But since here the question explicitly asked me to consider the calculations which are uh, at time of death. So that's why I have only considered the calculations applicable at time of death only, no other calculation. Thank you, Moses. Any further feedback, please? Anyone further? Okay, let me move ahead then. Propose gift to Hugu. So for proposed gift to Hugo, there are two properties which we have to talk about. There are two properties which we have to talk about. Point number one, point number two. Point number two, there are two properties which we have to talk about. One, we have to consider the IHT aspect of the property, and second, we have to consider the CGT aspect of the property. So there could be two possible presentations to this question. One possible presentation would be uh, one possible presentation would be where first house IHT CGT, or second CGT house 1 house 2, IHT house 1 house 2. I hope I am clear on this, right? Right. So whatever approach suits you, you can do it in that way. So no restrictions on this piece. You guys advise, you guys suggest, what should we do? First, house 1 IHT CGT, or CGT house 1 house 2 IHT house 1 house 2. So I want to hear from you guys, want to like your opinion on this. If you guys are there, let's do CGT house 1 house 2. Easter, I heard you. Uh, let me have either one or two more feedbacks, please. I prefer CGT and IHT house 1. So I have two feedbacks, and both are exactly on opposite direction. So anyone further feedback from like that would be convenient for me to conclude then. To avoid going back house 1 for the second time to save time. That's a fair point. So you have a fair point, Moses. I respect your views, but Easter also has a fair point where he is of the opinion uh, to see the difference, to like this approach, the one which is suggested by Easter. This will more emphasize or more point out, you can say, the difference between the two properties. So to Saviour's recordings, I honestly, I don't have the recordings. So for recordings, admin can guide, assist better than me. because they have all of the access relating to the recordings. So but that's not a like issue thing, that's easy stuff. You will get the recording. I don't know how, but well, like one thing is principally, yes, you will get it. Yes, so I believe we have 5 participants and I'm hearing from 2 only. Arsalan Sheikh, Hussein Pirwani, any feedback from you guys? So I hope no one will feel offended. I am going with the option two. Option two, as in, first I am covering the property one, IHT CGT aspect, like to have a better comparison in front of me for both of the properties, and then we'll look into the uh, property to IHT and CGT aspect. So I hope that would be fine. Please don't feel offended, like sir not accepted my suggestion. Both suggestions are equally worthy. Both of presentation formats are equally acceptable to the examiner. So let's talk about Eberhaus CGT. So this is my subheading, right? I'm underlining it. Let me have a look to again on the Eberhaus. Fiona owns a number of houses which she rent out to long-term tenants. These houses are located in either Parila or the UK. Fiona intends to give one of these houses either Eberhaus or Bleb House to Hugo within the next 3 months. Both of the houses were acquired in May 2016. CGT gift relief will not be available in respect of gift of either property. So CGT gift relief will not be available. The expected gain or loss on the disposal of each of 2 houses is set out below. Location, loss, gain on disposal, Aber House, Bleb House, fine. So I'm starting to address. Aber House is situated in Parila. Accordingly, tax relief will not be available in the UK in respect of the capital loss resulting from a gift of this house unless it is made after 1st August 2020, i.e. the date since when Fiona will become UK resident. 1st August 20 was the date, right? Sorry, 1st August 21. Then Eberhaus IHT. The IHT aspect of the Eberhaus. Eberhaus is situated in Parilla. Accordingly, the gift of this house will not be subject to UK IHT unless Fiona is domiciled or deemed domiciled for the purpose of IHT in UK. It has already been determined that once Fiona is UK resident, she will be deemed domiciled for the purpose of income tax and capital gains tax. However, she will not be deemed domiciled for the purpose of IHT because she was not resident for either of the two tax years prior to concludingly. Eberhaus would not be in the scope of UKIHT regardless of when in the next 3 months the gift is made. Aber House discussion. Any question? Aber House. Anything which is not clear? No feedback. So let me start with the Bleb House. On a gift of Bleb House, a gain of 85,000 would be subject to UK CGT. Regardless of whether or not Fiona is resident in the UK at the time of gift. It is because since 6th April 2015, residential properties situated in the UK have been subject to UK CGT regardless of the resident status of the person making the disposal. Bleb House, IHT. Bleb House is situated in the UK and UK IHT is applicable, is always applicable on UK assets, irrespective of domicile status. Bleb House is situated in UK. Hence, UK IHT will be applicable on it, as UK IHT is always applicable on UK assets irrespective of domicile status. Pleb House, discussion clear or anything you want to ask? Pleb House, is the discussion clear or anything still you want to ask? Good to hear this, Sevius. Any further person, any feedback? So if no feedback, I'm going towards the conclusion of this. We are supposed to conclude, right? So if I ask you guys, what is beneficial, to go for the Pleb House or to go for the Aber House? All of the discussions are in front of you. Good one. So Aber House should be gifted. Fiona should give Aber House to Hugo. After she moved to UK. This would create the possibility of obtaining the relief for the capital loss and would not have any IHT implication. Part B of the requirement. Is it clear? Is it not clear? Does it, as in like any confusion? Thank you, Arslan. Now, I'm heading towards part C, the taxation of overseas income. Thank you for the feedback, Moses. Why is that so? Thank you, Savius, for the feedback. Why? bold, underline. Taxation of overseas income. In the taxation of overseas income, there are two aspects to discuss. One is the explain why the remittance basis will be available to Fiona. So the first one is like availability of remittance basis. And second is income tax liability. Fiona, income tax liability. Availability of remittance basis. So let me look. Explain why the remittance basis will be available to Fiona in the tax year 22-23 and whether or not. So why remittance basis will be available and whether or not she will be subject. So two aspects to address within this requirement. Okay. The remittance basis is available where an individual is UK resident but not UK domiciled. Where an individual is UK resident and deemed domiciled where an individual is UK resident the remittance basis is automatically available if the unremitted income and gains in a tax year is less than 2000. If unremitted income and gains exceeds 2000, then remittance basis needs to be claimed. If an individual claims remittance basis, his annual exemption and personal allowance is withdrawn for that tax year. Accordingly, for 22-23, the amount of Fiona taxable overseas income will be automatically calculated on the remittance basis because her unremitted income is the Perillian Bank interest of 1200. Since Fiona automatically meets the remittance basis, hence no need to pay I'll be just back. Give me a minute. I repeat. So if there is any point, anything which is not clear with respect to this, should I start the working of income tax liability for the tax year? Perfect. So I'm going to start it. property income from UK. Interest income UK. This should be 0 because this income is unremitted. Total income. On this taxable income, $37,700 into 20%. So $37,700 into 20%. Then other income, right? The amount exceed from the basic rate high rate taxpayer double tax relief. Please expatiate why we are getting the property income from Perila. Guess I have missed out something. So since the Perillian property income that will be remitted to the UK, right? Moses, right or wrong? Yes. So since this income is already remitted to the UK, so this income will remain in the scope of UK income tax. Because whether the remittance basis is available automatically, not automatically, the income which is remitted to the UK would remain subject to UK income tax. But for example, since here the remittance basis is available and the interest income is not remitted to the UK, hence there is no UK income tax on such interest income. That's why I included this. Uh, this is what exactly mentioned in the question. So if I forgot to highlight that, Fiona will remit all of the rental income in respect of property situated in Parila to the UK. Where is my highlighter? Is it now fine? Perfect. Thank you. Double tax relief. Double tax relief is best way to calculate double tax relief is a three-step approach. What is double tax? What is the UK tax liability, including foreign income? Step two, excluding foreign income. Third step, take the difference. So the rate of income tax is 18%, 18% over there, right? So 31,000 multiplied by 18%. So that's the foreign tax, right? I need to calculate the UK tax, and are you talking about the income tax rates, Savius? Are you talking about the income tax rates? Mm-hmm. So probably I need to explain the amounts. So this is the 20%, the basic rate. Up till 37,700, the amount which exceeds from the basic rate from 37,700, taxed at 40%. So this is interest exemption because the person is high rate taxpayer, and the amount which do not fall into the exemption is taxed at 40%. Is it fine now? That's fine. UK tax. UK income tax liability, excluding foreign income. Starting applying the tax rates. So I can see the person is now the basic rate taxpayer. Hence, I can say the UK tax on overseas income is I'm done with the question, looking for your feedback, if any. Can I request for your feedback on this, please? Savius, the December 22 exam is available on the CB practice platform. So I left intentionally that piece for you guys to attempt it. So So generally, overseas related questions are of similar nature, where you need to be very careful about the dates element, importantly. Sure. The double tax relief is basically the difference of UK tax and foreign tax, right? So foreign tax, I hope that would be clear how I calculated. how I calculated the the foreign tax. The UK tax, like I explained, it is best calculated via a three-step approach. Three-step approach is first calculate the income tax liability, including all incomes, including foreign income. So I have already calculated that. So this figure is basically the income tax liability, including all foreign incomes. Then step 2 is recalculate income tax liability, excluding foreign income. So I recalculated that. What change over here I made, that is I excluded the property income from Parilla. So, and calculated one more income tax liability. Like I mentioned, it is excluding overseas income. So whatever is the difference between income calculated under step 1 and income calculated under step 2, the difference is UK tax on overseas income, which I put over here. And the lower off figure is my DTR. Welcome. Any further thing, or should I close it and move ahead? Can I close this Excel also? Thank you, Moses. Thank you, Arslan. Easter, I hope you're not lost anywhere. Thank you. Yep, Sevius, that is available uh, uh, towards the end of the session. Do remind me, I will share that with you. So let's start question number, section B question. So there are two questions, but considering the time, I personally believe we'll be able to solve any one question. So anyone of you has any particular thing like we should do question 3 or we should do question 4? Do let me know if there is any particular preference. Else, I prefer to go with the flow, i.e. prefer to solve the question number 3. But if there is any particular preference on any one of your side, I will do that. On this time, I will follow the FIFO basis. So if there is any feedback, like say we should do question 4, we should do question 3. So question 3 is on the screen right now. You guys can have a look towards question number 4. So Moses, probably on this particular piece, I need to look for the questions in which attempt it is available. So that's not right up in my mind. So well, my personal preference while looking towards the data of the question, the one-liner requirement of the question, is that we proceed with question number 4 because it is based on the share options, share incentive plan, which is not a usual thing to examine. So this is something which is usually examined in the exam. Simfire Limited requires advice on the cost of gifting computer or alternatively making a loan to one of its shareholder. Calp Limited has required advice on tax implications of replacing a factory and acquiring a new warehouse. So this type of question is generally a BAU type question, a common type question, which normally examines on a frequent basis. But if I look into this question, this is not a very, especially part A, Decon, the managing director of Y Limited, has requested advice on the tax implications of Yacon Limited setting up a tax advantage share incentive scheme for its employees. So this piece is something a unique kind of requirement which is not examined frequently. He also requires advice on the capital gains tax reliefs available on the sale of his house and the potential IHT liability arising on the gift of an apartment. So for this question, the first part, which is the share incentive scheme, that's not a usual component. Part B, capital gains tax, sale of his house, IHT liability on gift of an apartment. This is like a common feature. So I'm indifferent. So if I look into this June 21 exam, I can say like the residency is not tested directly, rather the overseas aspect is examined. But yes, I agree, overseas is something which is of either little marks or of major marks. Major marks as in like if I look into this paper, question number 3, Fiona, that is majorly. So if I exclude the 5 ethics marks relating to the Fiona question, the rest of 20 marks are primarily linked to the overseas aspects. So not particular residency, but as an overall overseas aspect. And in particular part B2, where we need to advise over the Aber house, Bleb house, uh, and the part C of the requirement. So, but again, if you ask me, overseas aspect is one of the most favorite area of the examiner, which is examined approximately in every attempt. So again, uh, question 3 versus question 4. Any particular preference? Is the point taken? So let's start with this question. So if time allows me, I would personally, I would love to do at least this part of the question. But let's look into this. That's subject to the availability of time. So Arsalan, again, depends how much time allows us. Again, my preference is to proceed with the both, but need to look for the time thing. So let me read the first line again, then we'll open up the exhibit. You should assume that today's date is 1st March 22. Semfire Limited requires advice on the cost of gifting a computer or alternatively making a loan to one of its shareholders. Full stop. Calp Limited has requested advice on the tax implications of replacing a factory and acquiring a new warehouse. The following exhibit available on the left-hand side of the screen provide information relevant to the question. Semfire Limited and Calp Limited, this information should be used to answer the requirements within your chosen response options. Noori, Noori owns 75% of the ordinary shares in Semfire Limited. Has been a director of Semfire Limited for many years. So from this point, I am like owns the whole of the ordinary share capital of Kelp Limited. Kelp Limited and Semfire Limited. So Noori owns 75% of Semfire, whole of the ordinary share capital of Kelp Limited. Accordingly, both of these companies sounds to me the close companies because uh, controlled by 5 or less shareholders. Semfire Limited is a UK resident close trading company which prepares accounts to 31st March annually. While will either, so it is also mentioned in the question, is a UK resident close trading company. Will either gift a computer to Noori on 6th April 22 or make a loan to Noori on the same date to allow him to purchase a computer. Uh, Alternative one, Semfire Limited give the computer to Noori. The computer was purchased by Semfire Limited in March 21 for 2600 and has a current market value of 1500. Semfire Limited has purchased no other plant and machinery for several years, and the written down value of its main pool at 6th April 2022 will be nil. Okay. The sale proceeds for the purpose of capital allowance will be nil. So there will be no sale proceeds with respect to the capital allowance. Uh, Noori private use of the computer has been insignificant throughout Semfire Limited period of ownership. Alternative two, on 6th April 22, Semfire will make an interest-free loan of 1500 to Noori. Semfire Limited will write off the loan on 6th April 2024. It's like they are clear from the start that the loan will be written off, right? K Limited, disposal of factory. K Limited is a UK resident trading company. K Limited was assigned a 48-year lease on Factory Building 1 on 1st November 2015, for which it paid a premium of 165,000. So based on the life of the asset, I can say it is a vesting non-chattel. K Limited used Factory 1 in its trade until 30th April 21, since when it has been rented to tenants who are not connected to the company. On 1st November 21, so from 30th April to 1st November, K Limited sold the lease with 42 years remaining for 206,000. Factory 2, Kelp Limited, acquisition of Factory 2. Kelp Limited acquired a factory building, Factory 2, from Semfire Limited on 1st May 21 and immediately start to use in its trade. Semfire Limited had acquired Factory 2 for 96,000 on 5th August 12. K Limited paid 138,000 for Factory 2, which was its market value on 1st May 2021. K Limited, acquisition of warehouse. K Limited will acquire a warehouse from an unconnected company for 78,000 on 1st April 2022. K Limited will occupy 70% of this warehouse for its own trade and will rent out the remaining 30%. So there is a reinvestment type of situation which I can see over here. Requirements: explain with supporting calculations the total additional taxes payable by Semfire if Semfire Limited give the computer to Noori, if Semfire Limited makes a loan of 1,500 to Noori and then writes off the loan on 6th April 24. Ignore VAT for this piece. Calculate the chargeable gain for Kelp on the sale of lease on Factory 1. Explain with supporting calculations the amount of chargeable gain calculated in B1, which will remain liable to corporation tax if Kelp Limited claim the maximum amount of rollover relief available. The following lease percentages should be used where necessary: 42 years, 48 years. The following indexation factors should be used where necessary: August 12 to December 17, November 15 to December 17. Explain with supporting calculations. Okay. Mm. Semfire Limited gives the computer to Noori. Yes, my dears, appreciate if you could share some light on this. I am supposed to mention the additional taxes. So not the total taxes, additional taxes. So let me start from the first line. The transfer of the computer to Noori will not result in a balancing allowance or charge in the main pool, as the proceeds will be of nil amount. There will neither be any capital gains on transfer of computer as it is a wasting chattel and having cost and proceeds of less than 6,000, hence exempt from capital gains. As Noori is director of Sapphire Limited, the gift of computer will give rise to a taxable benefit of 1,500, i.e. the market value of the computer at the date of the gift. Accordingly, there will be a class 1 ANIC for Sapphire Limited of 1,500 multiplied by 13.8%. Where was calculator? $207. corporation tax savings of therefore the total additional taxes payable in respect of this alternative for Simpire Limited are 207 minus 33, which is like sorry, not 33, it's 39. 168. At the moment, the question explicitly asked me to calculate the additional taxes payable by Sapphire Limited. So at the moment, I'm not supposed to consider the tax implications by Noori also. Needless to say, this would have the implications to Noori also. Why? Because if Noori, like, if it is a gift to Noori, so it will be a taxable benefit to Noori, which will be taxed as an employment income to Noori, because Noori is the director, right? So that will be taxed as an employment income to Noori. Over this, there will be income tax implications for Noori, but not at the moment point of discussion, because at the moment the requirement explicitly asked me to discuss the tax implications for should I wait for something? sorry, Easter, you explain basis for the class 1A and IC. So the reason class 1A and IC I am addressing it is a closed company. The company is giving the laptop, the computer to its employee. If the computer is giving to employee, there will be a taxable benefit, and the taxable benefit will be on the basis of market value. The taxable benefit would be on the basis of market value. Like it would be considered as a asset gift benefit of employment income, right? So from that perspective, I am covering these ending 3 points. Asset gift benefit. So since my perspective is the company, not the employee at the moment. So from a company perspective on the gift, there will be class 1A and IC. Class 1A and IC is a deductible expense for the company. As a result, tax would be saved. So net of tax, the expense for the company would be 168. I hope now that would be clear. So should we start part A2? Thank you. So let's start with if Simfire Limited makes a loan. I like to look into the requirement. So the requirement is of 6 marks. So I need to look into this according to 6 marks. Starting. Simfire Limited is a closed company as it is controlled by 5 or less shareholders accordingly. On making the loan to Noori, it must make a payment of notional tax of 1,500 multiplied by 32.5% So make it round 488. So can I make it round 488? To HMRC. The payment will be due on, what was the year end date? The computer was purchased in March 21, current market value 6th April 12, 22. which prepare accounts to 31st March annually. So apparently it sounds like a small company, and for a small company, the tax payment is due on 9 months and 1 day. So accordingly, the payment will be due on 1st January 2000, and it was made on 6th April 22. 6th April 22. The year end will be 31st March 23, and the tax will be due on 1st January 2024. The payment will be due on 1st January 24, 9 months and 1 day after the end of accounting period in which the loan was made. Following the write-off of loan, on 6th April 24, HMRC will repay all the notional tax to Samphire Limited by, so 6th April 24. Year end would be 31st March 25, 31st March 25, and 1st January 26. Writing off of loan is treated as income distribution, dividend, hence there will be no corporation tax implications for Samphire Limited. The loan was interest free. It will not give rise to taxable benefit to Noori, as the total amount of loan was less than 10,000 in a fiscal year. Accordingly, there will be no class 1A NIC. So to Moses, that is from the interest loan benefit perspective. That is not from the from this perspective. For this perspective, it has its own thresholds of 15,000 full-time employee kind of a stuff. So if the loan is less than 15,000 full-time employee and shareholding less than 5%, only in that, if these three conditions are met, then there is no need to pay 32.5% of loan amount to HMRC. So the point which you are referring is a separate, that is purely to the uh, loan benefit aspect. However, at time of writing of the loan, on 6th April 2024, as Noori is also employee of the company, there will be a liability to class 1 NIC, as it is treated as bonus for the Noori. Accordingly, Sempfire Limited will have a class 1 NIC liability of 1,500 into 13.8%, 207. We calculated this figure above, right? And
हाँ जी बच्चों ये क्या, ये तो मैंने खुद ही बना दी।
Who is the host? Aftabawan. Aftabawan, can you please make me host? Thank you. Therefore, the total additional taxes payable in respect of this alternative to Sempire Limited is also 207 minus 39,168. So I'm done with this part of the question. Let me look towards your comments, if any. What topic is this number referencing to? Is this employment income? I can't seem to understand the notional interest and the rate of 32.5. Can you just highlight this for me, sir? So this topic with respect to book, you are asking this with respect to the book or with respect to the notes, etc. So with respect to notes, that part of the corporation tax towards the end, we have the concept in the corporation tax of closed company. So that is under the umbrella of closed company. If you want, I can share, I can open up the respective um, slide for you, the respective PDF for you to join the dots if you want. So I'm opening the unannotated file at the moment, Easter, for you. So just so that you can cross check. Aftab, walaikum salam. So recording link. I don't have the recording link. The admin would share for sure. I know this thing. When, how, where, these questions are not familiar to me. So apologies for this, but you will get it. So this is for sure. Either by tomorrow or by Monday, you will get it. So this is, I hope you can see the PDF on my screen, Easter. So this is, to be exact, the points which we are discussing. Closed company, how to define a closed company, uh, benefits provided to shareholder, benefits provided to shareholder who is shareholder plus employee of the company. Here it is the 32.5% which you are referring, like what is this kind of thing. So the point which Moses was referring bit moment ago. So Moses, these are the three exemptions which are applicable of not to pay that 32.5%, which is completely different from the 10,000 figure of a small loan benefit. So allow me to close this. I'm done with, you're welcome. I'm done with part A2. Now let's look towards the part B1. Calculate the chargeable gain for CALP on the sale of the lease of factory 1. So I like to refer to working 1 on spreadsheet. Chargeable gain for CALP on the sale of the factory 1. There would be some disposal proceeds for this. The disposal proceeds are by the amount 206,000. Cost 165,000. So 165,000 is the cost. Multiply by remaining lease divided by total lease. So 96.593 divided by 99.289. Multiply by 96.593 divided by 99.289. So that's 160250. Indexation allowance. So this was purchased in November, 1st November to December 17. 1st November 15 to December 17. $0.070. That's quite dark. Can I move towards the part B of the question? B2. So why it is not in a mood to be copied? So I need to put the heading in my own wordings over here. So for B2, I like to gains remaining chargeable after claiming the maximum amount of rollover relief. Yep. So welcome. So just to recheck, this is again of 7 marks, right? Calculated on the lease on factory 1 for 6 years from 1st November 2015 to 1st November 2021. However, calculated did not occupy the building for trading purpose throughout the period of ownership, where the last 6 months, 1st May 2021 to 1st November 2021, it was let out. Accordingly, only three, 4, 2, 4, 4 multiply by 5.5 divided by 6. Three one three nine zero of the gain would be eligible for rollover relief. In order to relieve the whole of this eligible gain, Kelp Limited must reinvest 206,000 multiply by 5.5 divided by 6. I will delete it, okay? 188,833. In the business asset within 4-year period starting from 1 year before the disposal Apologies, I got disconnected. Now let me check who is the host so that I can request the host. Easter, you are the host. So can you please transfer the rights to me so that I can start sharing my screen? So on the chat side, uh, so likewise, I don't know why that's creating problem for me today. Uh, go to the to Easter, go to the participants, list of participants. Uh, go to my name, Syed Qunber Raza. You will observe 3 dots over here. Yep, that worked. Thank you. So, till here, anything to ask, anything to clarify? Okay, let me continue. The factory acquired from Samphire Limited, which is the factory 2 as per the question, is a qualifying business asset. Acquired within the year prior to the disposal of factory 1. Kelp Limited and Samphire Limited are not in a capital gains group as they are owned by an individual, not a company. Accordingly, the price paid by Kelp Limited of 138,000 is its relevant acquisition cost. As Kelp Limited will use the wholly for trading purpose, the full amount of 138,000 is the qualifying cost for rollover relief purposes. The warehouse to be acquired by Kelp Limited is also a qualifying business asset and will be acquired within 3 years of disposal of Factory 1. However, as only 70% of the warehouse will be used for trading purpose. Hence, $54,600 of its cost will be qualifying acquisition cost for ROR purposes. Accordingly, 54,600 plus 138,000. Accordingly, 192,600 has been reinvested in qualifying business asset assets. As this amount exceeds the 188,833, the whole of the eligible gain of 31390 can be deferred leaving an immediately chargeable amount of 34244 minus 31390. 31390 2853. So I'm done with the question. So I don't know whether you guys enjoyed this question or not. So if you look, that's a typical traditional rollover relief based question. But the point is the way it is asked, that is not the normal way or the usual way, you can say. So the way question is asked is a quite different way. So again, like I said, Moses, and the honest thing, so to be honest with you, yes, this question. So if this would have been calculation, so that piece would not be then so much difficult. But since this piece is more towards the explanation, which creates it, is it's more deep as you are referring. Any further feedback? Still, if anyone of you want to ask any particular question. Okay, thank you. I'll be sharing the 7 PDFs in the group in just immediately after closing of out this class. Thank you very much for being with me. Uh, I wish you guys the best of luck for your upcoming exams, the results, all that thing. My best wishes are with you. So I believe so, Moses, no, because that, okay, so with respect to Serzia, I'm not sure. I guess you are asking about the class uh, which was rescheduled, right? So let me have word on this piece. I cannot comment on this honestly, but do drop this query in the group. Sarzia will respond this. So I don't know honestly when he is planning to reschedule it. To Easter, give me time till Monday. So do expect the feedback by Monday, inshallah. You're welcome. Uh, thank you once again from my side. Take care. Good night. Inshallah, Easter, my best wishes and my best prayers are always with you guys. Always. So that goes without saying. Thank you. Allah Hafiz. Best of luck.